Something unprecedented is happening in the precious metals market right now, and if you're not paying attention, you're about to miss one of the most significant supply disruptions in modern history. Physical dealers are doing something they've never done before. They're refusing to sell. Not because they don't want your business, not because they're trying to drive prices higher, but because they literally cannot get their hands on physical metal to fulfill orders. Let me paint you a picture of what's actually happening on the ground level, away from the paper markets and the price tickers you see on financial news. Walk into a major bullion dealer right now, and you'll see something shocking. Empty display cases, out-of-stock signs on popular products, and dealers who are quoting delivery times of 8 to 12 weeks for products that used to ship in 3 days. Some dealers have stopped taking orders entirely for certain products. They're not even quoting prices anymore because they don't know when or if they can get the metal. This isn't a temporary blip. This is a structural breakdown in the physical supply chain that's been building for months, and it's accelerating. The silver market is experiencing lease rates that have exploded to levels not seen since the financial crisis. We're talking about rates that have gone from essentially zero to double digits in a matter of weeks. When lease rates spike like this, it means one thing. There's a desperate shortage of physical metal available for immediate delivery. Here's what most people don't understand about how the precious metals market actually works. There are two markets operating simultaneously. There's the paper market where futures contracts trade on exchanges like the COMEX, where billions of dollars in silver and gold change hands every day. And then there's the physical market where actual bars and coins move from refineries to dealers to investors. These two markets are supposed to stay connected, with prices moving in tandem. But right now they're diverging in a way that signals something is fundamentally broken. The paper price might show silver at a certain level, but try to actually buy physical silver at that price. You can't. Dealers are charging premiums of 30, 40, even 50% over spot price for immediate delivery. And even at those elevated premiums, they're running out of inventory. This spread between paper and physical prices is called the premium. And when it explodes like this, it's telling you that the paper market is lying about the true supply and demand situation. Let me tell you about what happened recently that should terrify anyone who understands market mechanics. Silver prices experienced a violent correction, dropping significantly in just 4 days. In a normal market, when prices fall that dramatically, physical demand should dry up. People should be selling, not buying. But the opposite happened. Physical demand surged. Dealers were overwhelmed with buy orders, and instead of being able to fulfill those orders at the lower prices, dealers started freezing orders, refusing to sell, or in some cases, dumping inventory below spot price just to clear their books because they couldn't source replacement metal. Think about what that means. Dealers would rather sell at a loss and get out of the market than take your money and promise delivery they can't guarantee. That's not normal market behavior. That's panic. That's a market that's broken at a fundamental level. The industrial consumption story is making this worse. Solar panel manufacturers alone are consuming silver at a rate that's stripping available supply from the investment market. Every solar panel requires silver for its photovoltaic cells. As the world pushes toward renewable energy, that demand isn't optional. It's structural, it's permanent, and it's growing exponentially. Add to that the explosion in artificial intelligence infrastructure, which requires massive amounts of silver for servers, data centers, and electrical components, and you have industrial demand that's eating into supply in a way that's never happened before. Central banks understand what's happening. They're not buying paper promises. They're accumulating physical metal at record rates. When you see central banks in China, Russia, India, and across the developing world buying thousands of tons of gold and silver, they're not doing it for investment returns. They're doing it because they understand that the current monetary system is built on a foundation of debt and paper promises that cannot be sustained. They're preparing for a reset, and they want to hold real assets when that reset happens. The COMEX, the major futures exchange where silver and gold contracts trade, has a dirty little secret. The amount of paper contracts outstanding dwarfs the amount of physical metal available for delivery by a ratio that would shock most people. We're talking about leverage ratios of 100 to 1 or higher in some cases. That means for every ounce of physical silver that actually exists in COMEX warehouses, there are 100 paper claims on that same ounce. This works fine as long as everyone plays along and settles in cash. But what happens when people start demanding physical delivery? That's what's starting to happen now. Contract holders are standing for delivery instead of rolling their contracts or settling in cash, and the exchange is struggling to find the metal. Warehouses that are supposed to hold registered silver available for delivery are seeing their inventories drain. Metal is moving from registered to eligible status, which means it's no longer available for delivery against contracts, and new metal isn't flowing in fast enough to replace what's leaving. The London Bullion Market Association, which oversees the massive over-the-counter precious metals market in London, is facing similar stress. Lease rates in London have spiked to levels that indicate severe tightness in the physical market. When you see lease rates at these levels, it means banks and institutions are desperate to borrow physical metal for immediate delivery, and they're willing to pay extraordinary rates to get it. This doesn't happen in a market with abundant supply. Let me take you back to a historical parallel that should make your blood run cold. In 1980, silver prices spiked to $50 an ounce in what became known as the Hunt Brothers Silver Squeeze. The Hunt brothers, wealthy Texas oil tycoons, tried to corner the silver market by buying massive amounts of physical silver and futures contracts. The market broke. Exchanges changed the rules mid-game to stop them. Margin requirements were raised. Position limits were imposed. The Hunts were forced to liquidate, and prices crashed. But here's what's different now. This isn't a few wealthy individuals trying to corner the market. This is structural demand from industry, investment, and central banks all converging at the same time that mine supply is constrained and above-ground inventories are depleted. The mining side of the equation is equally troubling. Silver production has been essentially flat for years despite rising prices. Why? Because most silver comes as a byproduct of other mining operations. About 70% of silver production comes from mines that are primarily producing copper, lead, zinc, or gold. Silver is just a bonus, so when those base metal mines slow down or become uneconomic, silver production falls even if silver prices are rising. You can't just open a new silver mine overnight. It takes years of exploration, permitting, and development. The supply response to higher prices is slow and uncertain. Meanwhile, above-ground inventories that built up over decades are being drawn down. The silver that was sitting in vaults, in old coins, in industrial stockpiles, is being consumed. Solar panels don't give that silver back. Once it's used in a panel, it's gone for decades. Same with electronics, medical applications, and other industrial uses. This is different from gold, where almost all the gold ever mined still exists in some form. Silver is being consumed and removed from available supply permanently. The exchange-traded funds that hold physical silver are seeing interesting flows. Some days they see massive inflows as investors pile in. Other days they see outflows as metal is redeemed and moved to private storage. This volatility in ETF holdings is another sign of stress. In a normal market, ETF flows are relatively stable. But when you see wild swings, it indicates that large players are moving metal around, trying to secure physical possession rather than trusting paper claims. Now let me address something important for those of you who are thinking about your retirement security and wealth preservation. If you're sitting on $100,000 or more in traditional retirement accounts, you need to understand that you have options beyond just stocks and bonds. I put together a comprehensive guide on how gold IRAs work, and it's available in the description below. This guide covers exactly how you can get physical precious metals into your retirement account without triggering tax penalties or early withdrawal fees. It explains the custodian requirements, the storage rules, and the process step by step. If you're concerned about the stability of the financial system and want to diversify your retirement holdings into physical assets, this guide will show you exactly how to do it legally and efficiently. It's worth checking out if this is relevant to your situation. Back to the supply crisis. The refining bottleneck is another critical piece of this puzzle. Even when metal is available, getting it refined into the forms that investors and industry need is becoming a problem. Refineries are running at capacity. They're quoting longer lead times. And they're being selective about what orders they take because they can't keep up with demand. This refining bottleneck means that even if mining production increases, it can't flow through to the market fast enough to relieve the shortage. The geopolitical dimension of this supply shock cannot be ignored. As tensions rise between major powers, as trade wars escalate, as countries look to reduce their dependence on the dollar-based financial system, precious metals become strategic assets. Countries that control mining, refining, and distribution of these metals have leverage. Countries that depend on imports become vulnerable. We're seeing export restrictions being discussed. We're seeing countries prioritizing domestic supply over exports. This fragmentation of the global supply chain for precious metals is another factor that's reducing available supply for the investment market. The derivatives market is another layer of complexity that most people don't see. Banks and institutions use derivatives to hedge their precious metals exposure, to speculate on price movements, and to manage their balance sheets. But these derivatives are built on assumptions about the availability of physical metal for delivery if needed. When the physical market breaks down, these derivatives become problematic. Counterparty risk increases, settlement failures become possible, and the whole structure of the paper market becomes unstable. What we're witnessing is the early stages of a supply shock that could reshape the precious metals market for years to come. When dealers refuse to sell, when premiums explode, when delivery times stretch from days to months, when lease rates spike to crisis levels, these are not normal market conditions. These are warning signs that the system is under stress and approaching a breaking point. The question you need to ask yourself is, what happens when this breaking point is reached? What happens when the paper market can no longer maintain the fiction that there's abundant supply available at current prices? What happens when the divergence between paper and physical prices becomes so wide that the paper market loses credibility entirely? History shows us that when markets break, the repricing can be violent and sudden. The move from $35 an ounce to $50 in 1980 happened in a matter of months. The move from single digits to nearly $50 in the 2011 bull market took years, but included periods of explosive gains. The smart money is not waiting to find out. They're acting now. They're securing physical metal while it's still available. They're willing to pay premiums because they understand that premiums are nothing compared to the potential repricing that's coming. They're taking delivery and storing it securely because they don't trust paper claims. They're diversifying out of purely financial assets and into hard assets that have intrinsic value and cannot be printed or created out of thin air. The retail investor who waits for confirmation, who waits for prices to break out to new highs, who waits for the mainstream media to tell them it's safe to buy, that investor will find that physical metal is no longer available at any reasonable price. The dealers who are refusing to sell now will not suddenly have unlimited inventory when prices are higher. If anything, the shortage will be worse because higher prices will bring even more demand while supply remains constrained. Consider the mechanics of what happens in a true supply squeeze. As physical metal becomes scarce, those who need it for industrial purposes will pay whatever it takes to secure supply. Solar manufacturers cannot stop production because silver is expensive. They'll pay up. Electronics manufacturers cannot halt production. They'll pay up. This industrial bid creates a floor under prices that's much higher than current levels. And on top of that industrial demand, you have investment demand from people who see the shortage and want to own physical metal before it's too late. The paper market will try to suppress prices through selling of futures contracts, through manipulation of sentiment, through coordinated actions by large banks and institutions that benefit from lower prices. But there's a limit to how long paper selling can hold down prices when physical demand overwhelms physical supply. Eventually, the paper market either has to deliver metal it doesn't have, or it has to admit that its prices are fiction. Either outcome leads to a repricing higher. The silver market is particularly vulnerable because it's smaller than gold. The entire above-ground investment supply of silver is worth a fraction of what the gold market is worth. It takes much less capital to move the silver market. When large pools of capital decide they want exposure to physical silver, they can overwhelm available supply quickly. We've seen this happen before in smaller squeezes, but what's building now is larger in scope because it's not just investment demand. It's industrial demand, central bank demand, and investment demand all hitting at the same time. The gold market is experiencing similar dynamics, but with some differences. Gold doesn't have the same industrial consumption that silver does. Almost all gold ever mined still exists. But gold has something silver doesn't have to the same degree: central bank demand. Central banks are buying gold at the fastest pace in decades. They're repatriating gold from foreign storage. They're building up reserves as a hedge against the dollar and against the instability in the global financial system. This central bank buying is persistent, large-scale, and price-insensitive. They're buying regardless of price because they're not trying to make a profit. They're trying to secure their nation's wealth in a form that cannot be devalued by another country's monetary policy. The dealer situation with gold is similar to silver, but with some nuances. Premium gold products like American Eagles, Canadian Maple Leafs, and small bars are seeing elevated premiums and extended delivery times. But larger bars, the kind that institutions and central banks buy, are still relatively available because that's where the market makers focus their efforts. The retail investor is being squeezed out while the institutional buyer is still being served. This two-tiered market is another sign of stress. What's fascinating is watching how different players in the market are responding to this supply shock. Some dealers are raising premiums to ration supply. Some are limiting purchases per customer. Some are requiring deposits and long wait times. Some are simply closing their doors to new orders. Each of these responses tells you something about how tight the market really is. In a normal market with abundant supply, dealers compete on price and service. In a shortage, they compete on who can actually deliver metal. The online dealers, who have become a major force in the retail precious metals market, are showing the strain most clearly. Their websites show out of stock on popular items. Their customer service is overwhelmed with inquiries about delivery times. Their social media is filled with complaints from customers who ordered weeks ago and still haven't received their metal. This is not a problem with one dealer. This is an industry-wide supply crisis. The mints that produce coins and bars are also struggling. Government mints like the U.S. Mint, the Royal Canadian Mint, and others have had to ration production, prioritize certain products, and extend delivery times to dealers. When mints cannot keep up with demand despite running at full capacity, you know demand is extraordinary. And this demand is not coming from speculators looking to flip coins for a quick profit. This is coming from people who want to own physical metal for the long term. The implications of this supply shock extend beyond just the precious metals market. If silver becomes genuinely scarce, it impacts the entire green energy transition. Solar panel production could be constrained. Electric vehicle production, which uses silver in various components, could be affected. The technology sector, which depends on silver for countless applications, could face higher costs and supply disruptions. This is not just an investment story. This is an economic story with real-world consequences. For gold, the implications are more financial and monetary. If physical gold becomes difficult to obtain, it undermines confidence in the paper gold market. It raises questions about whether the gold that's supposed to be backing ETFs and allocated accounts actually exists in the quantities claimed. It forces a reckoning between the paper price and the physical price, and it accelerates the move away from dollar-based assets toward hard assets that cannot be manipulated or created at will. The endgame of this supply shock is difficult to predict with precision, but the direction is clear. Prices will have to rise to a level that either brings new supply to market or destroys enough demand to bring the market back into balance. Given the structural nature of industrial demand and the strategic nature of central bank demand, the price level required to destroy demand is likely much higher than current prices. And given the long lead times for new mine production and the constraints on refining capacity, the price level required to bring significant new supply to market is also much higher than current prices. What this means for you as an individual is that the window to acquire physical precious metals at anything close to reasonable prices is closing. The dealers who are refusing to sell today are sending you a message. They're telling you that they see what's coming and they'd rather hold metal than hold cash. They're telling you that the risk of not being able to replace inventory is greater than the profit from selling at current prices. When the people whose business is buying and selling metal start refusing to sell, you need to pay attention. The strategy for navigating this supply shock is straightforward but requires action. If you believe precious metals should be part of your wealth preservation strategy, you need to act now while physical metal is still available, even if premiums are elevated. Waiting for lower prices or better availability is a gamble that the supply situation will improve. Based on everything we're seeing, that gamble is likely to fail. The supply situation is deteriorating, not improving. Demand is increasing, not decreasing. And the structural factors driving this shortage are not going away. This is not about trying to time the perfect entry point. This is about recognizing that we're in the early stages of a supply crisis that could lock you out of the physical market entirely if you wait too long. The premiums you pay today will seem insignificant if the predictions of a major repricing prove correct. And even if prices don't explode higher immediately, owning physical metal provides insurance against the monetary and financial instability that's becoming increasingly apparent in the global system. The dealers refusing to sell are the canary in the coal mine. They're telling you something important about the state of the physical precious metals market. The question is whether you're listening and whether you're willing to act on that information before it's too late. The supply shock is here. The only question is how severe it becomes and how high prices have to go before balance is restored. Those who secure physical metal now will be positioned to benefit from that repricing. Those who wait may find themselves priced out of the market entirely.